Good morning, everyone. The AI bears are back with a doomsday call on Nvidia, which reports earnings next week. We'll dig into the details on that. Markets are largely opening lower this morning. Surprise, no ceasefire deal. Iran with the Iranian conflict, oil down, oil up, excuse me. So stocks are down slightly at heading into the open this morning. One of the AI2 portfolio holdings will be added to the NASDAQ 100. I'll share that detail with you here in just a moment. Another heavy data week, but the key report that I'll be focused on will not be the CPI, the inflation report. I'll tell you which one instead here on the next slide as we get going. This is Breakfast Club. I'm John Hutchinson with Traders Reserve. Hope everyone enjoyed their Mother's Day. And hey, 2 weeks till Memorial Day. So hope you're having a great day. Let's get into what's happening today. Lumentum, stock symbol LITE, one of the stocks we've traded multiple times in the AI2 portfolio, was announced on Friday after the close that the stock would join the NASDAQ 100. Lumentum currently up around 5.5% to 6% this morning. That will cause some additional buying power in the stock as different ETFs and index funds have to reweight the stock based on the company's market cap. The stock has been doing just fine. We're up 35% in our fourth time owning Lumentum since last year. Second, again, still no ceasefire, Groundhog Day. Nothing more to say there. Oil will be up a few points today. But Wall Street, again, will not overreact as long as the shooting war does not restart. That's the trigger, no pun intended, for whether markets or how markets will respond to any details around the ongoing Iranian conflict. Finally, big data weeks. CPI is certainly important, but the bigger read for me is retail sales, and that's on Thursday. And the reason that I separate that, I don't think CPI will be much of a surprise to Wall Street. Wall Street will expect it to be higher, given the rise in oil and gas prices and energy prices overall in the last month. But the real question will be the impact on consumers. And while the March data and the initial impact of oil and higher gas prices was not, it didn't signal the end of the world or anything like that. April is really the first month with sustained higher gas prices, gas over $4 to $4.50 a gallon. So we start to see, or we will begin to see rather, the real impact on consumers, whether they've cut back anywhere else in their spending at the retail level. So that report is more important to me. Obviously, consumers account for the majority of the spending in the U.S. If we continue to see significant or sustained weakness in consumers, that will give us a different message. And we saw some of that last week, especially on Friday, as semiconductors and memory chips led a substantial rally in the NASDAQ. The NASDAQ outpacing every other index by multiples, 2 to 1 over the S&P, 2% completely over the Dow. So money moved to big tech, but away from industrials, away from general economy stocks. So almost every other sector was down on Friday, except for semiconductors and memory. So for those of us like AI2, holding stocks like Micron and AMD, we had a substantial rally on Friday in both of those stocks. We'll see how things play out this week. I keep calling for a consolidation week. Maybe this week I'll be right. We'll see. But let's move on to the real big story. I had an email sent to me from Dimitri over the weekend, pointing me to a Substack post, excuse me, about Nvidia. And I occasionally will peek in on Dr. Michael Burry's Cassandra Unchained Substack thing, publication. For those of you who don't know, Michael Burry was the one of the people who called the mortgage collapse in 2008, and his investment company was short heavily on mortgages, not mortgages, but swaps, etc. So he was featured in the movie The Big Short, and in his story of trying to short the market at that time. He's made a number of calls, almost always bearish. It's a, I don't know if he is ever bullish on any part of the economy, to be honest with you. But he's made a number of bearish calls over the last 15 years. And he has been heavily short on Nvidia, currently over $1 billion in short in puts on Nvidia, I believe at 110. But he was joined this weekend by Mark Westenberg and, to a degree, by Ray Dalio at CNBC. The bears are coming for AI, but there's a problem with their story, and I want to walk you through it and remind you, for those of you who attended my original AI2 Summit last September, one of the things that I told you was that I was originally a skeptic of artificial intelligence. So even though I am now publishing the AI2 Insiders and regularly talking about artificial intelligence in whether it's stocks, whether it's what's happening in the industry, what the future may look like, it does not mean that I only believe that AI is the entirety of the stock market, because that would be fundamentally false. And it does not. It also doesn't mean that I'm not cautious about artificial intelligence, because I actually have been. But what I want you to take away from this walkthrough is the need for investors to do their own research and analysis, or ask for help if you're not sure, because the way that they're positioning their case against Nvidia ignores a pretty lengthy fact set of what's happening right now. That's number one. And number two, the comparisons that they make fail on a number of levels. Now, that doesn't mean that Nvidia is always going to be the most profitable company ever, right? Grain of salt, pound of salt, take your choice, take your pick. But when you're trying to navigate between these heavily bearish calls and even heavily bullish calls, the truth is always going to be right in the middle. It will always land in the middle of things. So let's talk about briefly what their case is built on. First is customer concentration. That Nvidia, for example, 4 customers account for 61% of their revenue. 2 customers account for 37%. We've talked about Teradyne, stock symbol TER, and the challenge that Teradyne has in the same category, customer concentration, having too few customers, limiting the expansion of their revenue and or their earnings. Well, the same case is now being applied here to Nvidia, but not recognizing that those customers, Microsoft, Amazon, Meta, and Google, are the ones leading the build out for artificial intelligence at this point in time. What they're not taking into account there is that could change in the future. That leads to the second part, which is the CapEx, capital expenditures, the money being spent on building out artificial intelligence. They're claiming it's too much money, but now they're also claiming that this is going to change. They're targeting asset life mismatch, which no investor gives a rat's patootie about. But essentially, their argument is that the way that companies are now accounting for the life cycle of a semiconductor or a memory chip is akin to the way that that MCI WorldCom was basically faking their build-out data in revenue in the late 1990s. MCI WorldCom, Bernie Ebbers, you may recall, that company collapsed following extensive accounting fraud. None of these companies today are being accused of accounting fraud. Fourth is substitution risk. This is a legitimate pillar. And I will point that out. At some point in the future, Nvidia will not be the sole or single supplier of all things artificial intelligence. But that's a natural change in competition, in cycles, in the evolution of technology. So, to a degree, they're right that there does exist the risk of Nvidia's for customers beginning to substitute out for the GPUs that NVIDIA supplies. That's legitimate, but it's not as if NVIDIA doesn't know that or won't plan for it. So it is a key piece though, and it is accurate enough in that sense. And the fifth is circular financing, which is money and warrants and shares, all of these unusual deals that are being put together between companies like NVIDIA, which owns shares of Intel, or NVIDIA investing in companies like Lumentum, which just joined the NASDAQ. But these are investments that are made in ensuring the consistency and continuity of the supply chain, which right now is the bottleneck that the hyperscalers are faced with in trying to build out AI capabilities and scale and speed at a faster pace. So in one sense, NVIDIA is lifting the entirety of the supply chain market by making cross investments into other companies, and nothing that they're doing is illegal. But the other piece of the puzzle that was pointed out by Westenberg was the Cisco story, and this is one of those points where it pays to do your own analysis, because Westenberg's point was if you bought Cisco back in 2000 when it was $80 a share, that it took you $25 to break even. Okay, if you bought Cisco, and if you bought it at $80, and if you bought it at the high. That's the problem with these types of comparisons. Because here's my comparison. I could hyperbolize and say, well, if you bought 100 shares at 80, 100 shares at 55, 100 shares at 35, 100 shares at 20, and 600 shares at $8 at the 2002 low, well, you'd be up 237%. That's the problem with that type of analysis. So be cautious when you see the if statements like that, and even from us, because it's not necessarily giving you a realistic comparison, and it's also not reality. Every investor who owns Cisco did not only buy Cisco in 2000 when it was $80 a share. And Larry Ellison, who owns hundreds of millions of shares of his own company, is a billionaire. So I don't know that he's worried about the price of his stock so much. But that one little window is the trap. And that's how they try to convince people that they're right. Whereas we focus on what's happening, who's making money, and can we prove that they're making money? And if we can prove that they're making money, then we can validate the price of the stock at the present time, not 25 years ago, and not anything that has happened ever since. So 22 out of 25 years, the stock has trended higher. So is Cisco really a lesson, or is it really a poor comparison? And in my mind, it's a poor comparison. And it's Cisco from a different era versus today. Now, Cisco is a leading investor in the development of in artificial intelligence. They're a beneficiary of many of those circular financial deals. They have taken on extreme levels of debt where they need to show growth in their earnings. So there's a story for Cisco, but it's also a reason why we don't own Cisco in our AI2 portfolio. We tried it a couple of times. It didn't work. We left it alone. There's not a fundamental story for me for owning Cisco right now. Maybe for the long term, for a longer term investor, that may be different for them. But when somebody uses their bearish case and builds it on an example like this, that weakens the case to me, because you're not making the same argument here. And here are some of those other comparisons that just don't work. I mentioned MCI WorldCom. Billions of dollars in what can only be called outright fraud. Um, Global Crossing, same thing. They executed essentially accounting fraud, and the company went bankrupt in 2002. Another example that Westenberg used were railroads in the 1873 and 1893 collapses. They were rife with fraud. Notice the theme here: fraud, fraud, fraud. None of that's happening. That doesn't mean run out and buy Nvidia or run out and buy every AI stock just because it's an AI stock. It means understand how these companies are making money. And when there are these circular financial deals, take the time to read up on them and understand, is it a legitimate investment in the company? If it's in some cases, it's buying capacity in exchange for chips. But the key for me is, and we don't own Nvidia in the AI2 portfolio. I'll share that in a minute. But the key is you have to do the research, especially with new technology, especially with the underlying stocks in this entire sector of artificial intelligence, almost in what can only be called parabolic moves. Those tend to pull back substantially at some point. There will be a significant correction among AI stocks at some point. I don't know when that is, but it will happen because it's the natural order of things in the market. The dot-com of 2000, I've talked about this ad nauseum, but the reason it's not the same comparison is the dot-com era was driven by IPO hype. And most of those companies that were going IPO had no revenue. They had no source of revenue. They had no business being an IPO or being added to the stock market at all. And finally, we talked about the Cisco. There are parts to the Cisco comparison that could fit here. The argument being made that it was, they collapsed because of the fiber build out. And that may be partly true. I think I said Larry Ellison, and I didn't mean that. I said that incorrectly. Larry Ellison owns Oracle. My mistake. Sorry. It's early and had a long weekend. Funeral stuff. So I apologize. I'm not 100% on my game this morning. But at any rate, Oracle is another one of the major beneficiaries and investors in artificial intelligence, not Cisco. So at any rate, but the Cisco comp has some similarities, but not 100%. It's still a relatively weak. And the other issue really here is when we look at the Microsoft, Google, Meta, and Amazon complex, they're investing cash. They're investing cash from operations into the artificial intelligence build out. And so one of the arguments that both Burry and Westenberg have made is that, and Westenberg has predicted that one of those four companies will come out in early 2027 and say something along the lines of rationalization or decreasing expenditures on capital expenditures build out. So their claim there is that that's going to lead to a massive, like the end of AI. We'll put it that way, right? A little hyperbole, but that's their claim. Well, here's the problem. One, it's not a binary event because much of Wall Street analysts' complaints over the last 6 months has been the increase in CapEx. And in many instances, after companies have held their earnings or reported their earnings and held their earnings conference calls and detailed those increases in CapEx, Wall Street has actually sold those stocks off because their fear of the amount of money being spent on artificial intelligence without a timeline for profitability on artificial intelligence. Right? This is what they've been complaining about. So if the core four, Amazon, Meta, Google, Microsoft, suddenly say, hey, we're going to start reducing capital expenditures, does that guarantee that Wall Street is going to suddenly spin out of control into a sell-off? Not necessarily, because in any of these different states, there could be different outcomes. Wall Street could look at that positively, meaning that cash is not being spent, therefore it's being returned to the shareholders, therefore the stock has more value. It could be that the capex is generating a higher rate of revenue and thus earnings, and therefore doesn't require the same level of capital expenditure. But there could be a state where the bears are right and the entire infrastructure play blows up. But that's one of three possible outcomes. They're treating it as their case is the only possible outcome. And that is, to me, that's dishonest bear play. And that's what gets me mad. Sorry, that's what gets me mad on a Sunday. And if actually, let's go back one moment here. I thought I had a slide for it, but maybe it's not here. We'll come back to it in a second. Anyway, for Nvidia, the bears are saying that the stock is overvalued by 50 to 70%. But it's trading at 40 times trailing earnings. So it's only trading at roughly 20 plus times forward earnings. So it is not trading like Cisco did in the late 1990s at a 200 plus trailing price to earnings ratio or a 180 plus forward price to earnings ratio. This is true of companies we hold like Micron and AMD, where both their trailing and forward price to earnings ratios are much more historically in line with tech stocks where they should be, not indicative of like crazy numbers. And many of the companies that we own in the AI2 portfolio follow the same model: lower forward earnings multiples, which means we're buying future growth at a discount because all of these companies that we hold have higher earnings projections for this year, for next year, and even into 2028. So the bears are betting against one forward multiple, whereas we own 12 companies whose past quarters have already proven their earnings play, that their earnings are growing. They are growing faster than Wall Street anticipated, and therefore Wall Street keeps repricing these stocks. And so when you look at what they're claiming, their case, the other thing that they don't address is where we are in the artificial intelligence cycle. This is on the top line here, right? This is the internet, roughly, right? And somewhere right around here, 1999 was the first Wi-Fi router from Apple. It was the first time that Apple made Wi-Fi available. But it really wasn't until right here between 2003, 2008, that Wi-Fi really became available to consumers. That's a 10-year cycle just to increase speeds to what was then 10 megabytes. And today we're talking about gigabytes, right? So this entire infrastructure build out, which is still ongoing, has taken 30 years. Well, we're here in AI. We're starting to move into the agentic AI. That's the next big thing, so to speak. At some point in the future, you'll have artificial general intelligence. That's 2 to 4 years away. Quantum AI, maybe. Artificial superintelligence, maybe. But those are still 5 years into the future, most likely. But my point here is they don't address this. They're only talking about here. Right? They're talking about AI today. They address nothing about the future of artificial intelligence And that's the other area where they're being dishonest as bears, is they're not looking at what happens in the future. Because if you think about it, and we've talked about this at length in the AI2 program, the semiconductor and memory chips that they're making for this level of artificial intelligence are not the same chips that will be needed here, here, or here. The servers, not the same here, here, here. Fiber, optics, the optical complex, uh, everything that builds into a data center will have to change as we go through each of these different stages, just as everything changed from here to here to here in the internet age. Same thing in the computer age, moving from an 8086 to a 286 to a 386 to Pentium chips. All of that required faster and more compact, smaller semiconductors and memory chips, increased storage devices for hard drives. Right, it's you get the point, right? It's not like we're driving a 1979 Pinto and just changing the tires. Right, you got to change the engine too, otherwise it stays a Pinto, and nobody liked the Pinto. So at any rate, the bears are pricing one generation, but the way that we're approaching artificial intelligence is looking at the future as well, and being able to identify which companies have the potential into the future for the future. Excuse me, for the future. And the other thing, the one last point, I know I'm making too long of a point, but too bad. Amazon has. Last I checked, you can still get things on Amazon.com. You can still watch or use Amazon Prime. Google still owns YouTube and YouTube TV, Google Workspace, Google Cloud, etc. Microsoft still sells Microsoft Office, Microsoft Cloud services, etc. Meta has not shut down Facebook last time I checked. In other words, the mistake that the bears are making in their argument here, by extension, is failing to recognize that the core four, supported by Nvidia, are diversifying their technology footprint. They are not relying on artificial intelligence as the sole source for their revenue. And that was not true of companies like Cisco, MCI, Global Crossing, Enron, et cetera, back in the late 1990s, all companies that collapsed heavily at the end of the dot-com crash. So there is a world of difference, right? These companies already have revenue streams. Those revenue streams are being maintained and still growing. And in some cases, like Microsoft Office, Microsoft is adding artificial intelligence to its Office complex. Google added Gemini to its Google Workspace complex. Facebook is adding artificial intelligence to its, Meta is adding artificial intelligence to its Facebook complex. I don't know why, but they are. Right? Amazon is incorporating artificial intelligence into Amazon Prime, and other holdings. So it is supportive and diversifying their existing business as hyperscalers. That's the other point that continues to get overlooked or ignored. And it's why I frankly, get mad about the way that the bears keep pressing their case. Remember, bears are always right, like a broken clock, once or twice every decade. That's it. If it's worth $1 billion for Michael Burry, good for him. Me, I'm going to take instead the 62% gain we've had in the AI2 program in the last 90 days on roughly $42,000 invested capital, and my 102% return. That is a new milestone. That is year to date in the AI2 Insiders program. Currently, we hold 12 stocks. We've closed a few positions over the last month and a half, but year to date, $35,000 is now worth more than $70,000. Why? Because we're focused on these two segments right here: supply chain and core. We don't own Nvidia. We don't own Microsoft or Meta or Amazon. We briefly owned Google and made $3. Instead, we own Micron and AMD, Lumentum, Coherent, Ciena, and other stocks that are the suppliers to the data centers. You can do the same research and find the same kinds of stocks. And what you'll find is those are the companies that are generating revenue. One final nail in the coffin here. The argument that all of these chips and servers are sitting in warehouses gathering dust. Okay, but they've been paid for. So the revenue has already been realized by the companies that sold those servers and chips and memory and storage, et cetera, that are allegedly gathering dust in warehouses in some unnamed city in some unnamed country. But our focus continues to be in supply chain and core. At some point later this year, maybe in the summer, I want to start moving into frontier and solutions. I think software starts to make a comeback. We saw that last week with companies like Datadog and JFrog. These are Penguin Solutions. Penguin Solutions we talked about and traded last year. They're a company that is trying to rebuild their business into artificial intelligence. That company has moved substantially following an earnings miss in October. It has recovered and might be surprised. Last time I checked on it a week ago, the stock was trading close to $30 a share after falling to as low as around 15-ish or so. Small companies, they are out there. They exist. They are doing great things in the artificial intelligence realm. So just because Michael Burry got one call right 15 years ago doesn't mean he's going to get this one right. And could be an expensive loss for him at that. But that being said, we're doing well. Our AI2 index up 23.6% for the year. That's the full index of 350 plus stocks. That means there are a score of winners. There are also losers. That is a normal, healthy market as far as I'm concerned. Last week, I mentioned earlier that we had a significant number of sectors that were down. Semis, memory, mega cap was partially up, communication services partially up. But generally speaking, this sector, these four sectors here are beginning to show cracks in the consumer realm. That's why retail sales is what I will be paying attention to. I mentioned that the NASDAQ lapped everybody else. It was 2x the S&P, 2.5x the Russell, and nearly one and almost 2% better than the Dow last Friday. That is an important trend to keep an eye on. If we continue to see weakness in the Dow, in the S&P, even to a degree in the Russell, that will lead to some corrective action at some point, likely in the summer, maybe sooner. But keep your eye on that. So retail sales this week, and then see how that translates into key retail sectors, especially health and financial, consumer staples, consumer defensives, consumer cyclicals. That if those sectors are in the red again this week, that would tell me that Wall Street is starting to pull back from consumer-led activity and maybe beginning to become a bit more concerned about the overall economy. So bears are making a long-term argument with bad comparisons. That's my story for the day. But the results that we're getting trading the right AI2 stocks tell a better short-term story with real money. At the end of the day, both of those stories can be true. Your job is to know which one you want to buy. Because the problem with the bears is scaring people away from one stock, ultimately from all stocks, rather than identifying stocks that you can own or trade right now today for 5%, 10%, 20%, take your pick. One of our stocks in the AI2 portfolio, Max Linear, is up 400% in 90 days. The gains are out there. It's your job to find them, or you can ask for help. We'll help you find them too. So let me take a quick look and see what we have. A couple of points. Good morning, everybody. Good morning, Don. Good morning, Joe. Good morning, Tom. Anna. Hello, Anna. Anna, a quick follow-up on your question on Jane Capital. I researched that. the market manipulation end of your question from AI2 last week. Since we don't have AI2 this week, I'll just drop you the quick answer. The market manipulation happened in India. And it was action brought against Jane Capital for interfering in the Indian markets, not the US markets. But just to clean up a little point on that one, White House worried Anthropic may not have enough compute to provide top service. And I don't think it would be limited to Anthropic. I think it would be extended to OpenAI or any other company providing computational AI, so to speak. Here's the thing to think about, and this is probably me soapboxing, so take it for what it's worth. The race right now is between the United States and China for artificial intelligence dominance. Which country would you prefer win that race? Because to me, it ain't China. And we've heard nothing out of DeepSeek for months on end since they originally released back in January 2025 and upended the markets last year. But my one concern is that the U.S. government not get in the way of the expansion and the capabilities and the research, the investments needed in the artificial intelligence in this country. Not because I think AI has to rule the world, so to speak. I don't want that. But because I don't want the only models being available coming from China. So you're right. The Anthropic, which is technically not a U.S.-based company, but the battle for OpenAI and control of OpenAI with Sam Altman and Elon Musk. My hope is that Altman wins that lawsuit and OpenAI retains its current leadership board, because I don't want Elon Musk owning or controlling that company either. Not that, and along with SpaceX and X and Tesla, et cetera. OpenAI has continued to make advancements. Let's recall that OpenAI was the original open source artificial intelligence, and they gave their model away to countless businesses. And only later did they begin attempting to monetize it. And what started as an open source project has turned into a need to monetize it because of the investment and scale of investment necessary to build, not just for today, but for 2 to 5 years from now. So your point on worrying about the computational capabilities is accurate. In part, you're right. It's not overbuilding. That wouldn't be the concern. It's every company that is in the entire stack of technology being able to advance rapidly enough, and at the same point in time, right now, where we already know we have massive supply constraints. And I don't know, maybe eliminate tariffs. Just a suggestion. Maybe get a ceasefire deal that reduces the cost of energy and fuel, et cetera. Just a suggestion. But the underlying point you're making is accurate, that if the concerns at the government level for the ways that they may utilize artificial intelligence is that the computational capabilities, scale, and speed are not at a level that they need, then we're still behind in the development and in the build out. So that's a great point. Excellent. And keep in mind too, that the biggest challenge for artificial intelligence at the business level is still the knowledge gap. And that is a knowledge gap that extends to the C-suite, to the end, from the C-suite to the end user. It is, and even Dave and I have been through different ways that we can use artificial intelligence in what we do. You have to learn what it can do, test it, prove it, discard what doesn't work, and then make improvements to what does. So that knowledge gap has been is still a user constraint. And at this juncture, we're not even talking about consumer-based artificial intelligence programs, products, services, et cetera. Although we've talked about Walmart Sparky a couple of weeks ago, their online shopping assistant, and the impact that it has had on Walmart's earnings at the, call it the digital shopping level. We really don't have a true infrastructure of artificial intelligence products yet, not at the consumer level. That too, that's years away. So you're right. That's why I make the point that the chips of today are not the chips of tomorrow. They're not the chips of 2028 or 2030. This is not a one-time build out. It is an ongoing build out. And that is something that I think both Burry and Westenberg are guilty of overlooking, and making a bearish call on one stock. The other issue that I had is, what was your alternative? That's the other problem that I have with the bear calls. What's the alternative? Because the alternative isn't buy gold. So what's your alternative? So don't just tell me that you don't like the stock because of circular financing or this thing or that thing or et cetera. What's your alternative? And they don't have one. And that, for me, that is a problem for me, because what it does is it leaves you with no answer other than, okay, I won't buy Nvidia, but then, well, what do I do with my money? And GameStop and eBay is not the place, which was another thing that Burry went down, and the GameStop acquiring eBay, or maybe it was eBay acquiring GameStop, whichever way that went. That's the problem. If there's not an alternative, then what's the purpose here? Excellent point, Anna. Thanks very much. Reminder for folks, no AI2 insiders today, and Breakfast Club will be off for the next 2 Mondays, and we'll be back on Monday, June 1st. I'm traveling next Monday, and the following Monday is Memorial Day. So in advance, I hope you have a great Memorial Day weekend. I hope you have fabulous weather. Get the hot dogs and hamburgers out, and just have a great weekend. Hopefully, we can ride the next 2 weeks even stable to slightly higher, and get to the first real weekend holiday of the upcoming summer on a high note. So thanks for joining me. I'll see you again on Monday, June 1st at 9 a.m. For everyone here at Traders Reserve. And have a great trading week, and we'll see you in your next trading session.